Today we're diving into a topic that trips up so many entrepreneurs, getting a mortgage when you are a business owner. And we know that being tax efficient often means showing less taxable income. But what happens when that works against you during a mortgage application? Whether you're leveraging the home office deduction, hiring your kids, or claiming depreciation, we're going to talk about how that all plays into your ability to qualify for a mortgage. Joining me is a seasoned mortgage lender, and today we're unpacking how to prepare, what lenders are really looking for, and strategies that you can use to implement to improve your mortgage game down the road. Stick around. This episode could save you a lot more than just tax dollars. And again, today we're going to have Bill Miller on to come discuss this whole mortgage and being a business owner. And Bill's been on the podcast. It was a while, and I thought, things have changed quite a bit since the last time you were on, Bill. And so I wanted to kind of refresh and see where we're at and kind of give the audience an idea of what this looks like. So Bill, welcome to the show.
Thanks for having me, Mike. Glad to be here.
Yeah, I'm excited about this one too, because it is something that comes up so often. So let's start with the business, or the basics about getting a mortgage for a business owner. How does being self-employed or a business owner change the way that you approach kind of a mortgage approval process compared to just say, your average normal W-2 employee?
I would tell you that it's been ever changing in the way that we manage risk when it comes to the way someone who is self-employed is going to demonstrate their ability to repay. If you take the time frame that was up until 2010 off the table, when we were doing loans and evaluating income in very unique ways, for the purpose of our discussion, I'm going to cite Fannie Mae and Freddie Mac guidelines in the way that I explain things, because people who want loans that are going to have to go with non-traditional guidelines, all of those programs really have a really broad interpretation. So when you're self-employed and you want to go and get a 30-year conventional mortgage at an attractive interest rate, we have to look at, for people who are self-employed less than 5 years, we have to evaluate 2 years of either their Schedule C, or we have to or Schedule E, of course, if it's rental property, or we have to look at 2 years of their corporate tax return with their K-1. And we're looking at, with those situations, like right now, I'm still encountering people who filed extensions on their taxes, of course, which is pretty normal for a lot of self-employed folks. And so in that scenario, instead of getting their 24 and their 23, we would be getting 23 and 22 with a P&L and a balance sheet for them to demonstrate that their income trend is still in the place that it represented in the previous 2 years.
Makes sense. So, a thing that we talk about a lot on the podcast is just to say, what are some of these strategies? And I have to talk about this concept of moving after-tax spending into pre-tax spending. And when I talk about that concept, I'm saying, hey, don't go out and buy like a new truck that you don't need for a tax deduction. But what if we can take spending that you're going to do no matter what, but instead of doing it with after-tax dollars, how do we move it into pre-tax dollars? And I think one really easy example to do that, or to explain that, is hiring your kids in your business. And so let's say we have a 12-year-old kid, and I know I'm going to be putting them through basketball camps or baseball camps or volleyball camps and giving them money to go to amusement parks with their friends. And I say, how about this? Instead of me just funding that life, how about you come and work for my business? You do some social media posting. My business doesn't really need the social media posting, but hey, it couldn't hurt, and here's a really good opportunity to learn to work for a living. So why don't you come in, do some social media posting? I'll pay you a reasonable rate for the work that you're doing, and dot my I's and cross my T's on that strategy. But now I just said I paid them, let's say $5,000 a year doing that strategy. This was money I was going to spend anyways. It just was out of the business before. Now I'm doing it in the business, getting a business deduction. Child pays no income taxes, which is all good for tax planning purposes. But when we talk about a mortgage, now we're showing $5,000 less in income. It's not additional money spent because that money was still being spent elsewhere somehow, but we're showing on paper in my profit and loss $5,000 and less. So how does that that's just an example of one strategy among many that we do, but how does that kind of play into what you look at when you're talking with a business owner?
Well, it reduces your income by $416 per month because I can't add it back.
Yeah. Okay.
I'm not allowed to add it back. So we can add back depreciation, amortization, which we hardly ever see. There are certain things that we are allowed to add back. But in the scenario that we're discussing here, that is a very, very popular trend that you're referring to. But unfortunately, it just basically gets it gets deducted from your net income, and there's nothing really that I can do about it.
Makes sense. So when we're talking about kind of looking over financials for a business owner, what as a lender do you really care about? Is there specific things that you're looking for? Because I'm just trying to understand, what are some of the recommendations we make to these business owners? We want to save on taxes, right? That's priority. But if by saving on taxes, we're losing out on opportunities to buy a rental property, get into a house that we want, and different things like this, is there a point in time where sometimes you're like, okay, let's claw back on the tax savings for a little bit and, try to build up those tax returns for the mortgage that I want to get? Or, in some instances, and I think we've had conversations about this, is that the house or the property that they're looking for, they don't even really need that all the income that they have. Like, they have more than enough income to more than qualify for. So from a lending standpoint, kind of what are you looking at from that aspect?
Sure. So ultimately, in a scenario like that, when I go into these kind of discussions, the number one thing I can tell you that anybody should do, especially if you were in a case where you know that you're going to want to buy a house in Q1 of 25 or Q2 of 25, let's say. So you're going to actually go and have a conversation with someone like myself, have a conversation with you, probably, close to the end of the year, and just try to do some pre-planning so that you can actually establish like how much income you actually really need to get this mortgage. Oftentimes in January and February, that's when I'm having the majority of my discussions with my self-employed past clients or people who I've been referred to, because we're literally looking at a draft of the tax returns and having them say, Bill, will this work or not? Because if we're in a situation where, I could go get that new vehicle that exceeds the gross vehicle weight limit, and I could put it in my name for a big deduction, or I could go buy that new piece of equipment. Those are all things that at the end of the day, we have to standard 50% income to debt ratio. So we work with a lot of folks that are using an 1120S tax return on an S Corp, and they W-2 themselves, so we can use that. Let's say they're in partnership and they've got a K1 coming in. I can take the K1 income. I can add back the depreciation. But then what I'm having to look at as a part of the whole situation is I have to do a business liquidity analysis. And that one on the 1120S tax return, that has been a big hurdle because there is a cash and cash equivalent formula that I have to meet with Fannie Mae and Freddie Mac in order for people to actually get their mortgage. And you can have a situation where you don't meet that formula, and then all you're only able to do is use your W-2 earnings and not your K-1 earnings, which is really frustrating to some applicants.
Yeah, no, that makes sense. And so remind me again, I know you just mentioned this too, but when you look at add backs, what are the items in that add backs? Depreciation, amortization, is it just those two mainly?
Basically those two things. I have to subtract meals and entertainment. Basically I don't get to use business use of home towards qualifying anymore. That's been flushed out. So yeah, really that's about it. Oh, let me say also, I forgot this one, miles. I'm allowed to add back mileage.
Okay. So and just to correct, if I take a home office deduction, that deduction is not being added back to my income.
No, it's not.
Interesting.
I'm looking right at the headlines right in front of me. I did a little sheet of bullet points. And unfortunately, years ago, we used to put business use of home on our income docs, but we no longer do.
Yeah, that's so interesting because that does directly contradict kind of someone that's a heavy tax planning focused versus somebody that also that same person wants to get a mortgage. But depreciation is interesting. So if I have let's just say I have $100,000 of income, I go out and buy a $100,000 car that I can depreciate in year one, and for a piece of equipment, whatever it might be, and I show zero profit. You're saying from a mortgage standpoint, we're adding back that depreciation. Is it 100% add back?
100% add back. Yep.
Yeah. So in that case, we still made $100,000 of income, even though only zero was, we showed zero taxable.
Correct. 100%. Yes, you can do
Got
that.
it. You know, I would love to talk to Mr. Fanny and Mrs. May about what I consider some of these ad backs, but you know, I get it. Like, where would you draw the line, and then also how do you prove, like, okay, if you do hire your kids, government's going to say, well, that's an employee, like you need them to run your business, and me as a tax planner saying I don't really need them. I'm using it more for a tax play, but it's also is serving a purpose and has some other benefits. But where would you draw the line? You know, next thing you're saying, I have a employee I'm paying $80,000. It should be an ad back because you know, I don't really need them. I'm just supporting them. You know, there could be some fuzzy lines, which is probably why they got to be so strict in that area.
Well, I think there's been ambiguity around all of this for a long time. It's like people start figuring how far they can stretch the boundary on it. You know, like for us, when we're helping people figure out what they should do or not do, like I'll give you an example. I just had a client come to me the other day, and this is something that maybe you can speak to. So I'm looking at their tax returns and they go, well, Bill, we take the majority of our income in distributions. And I was in a situation where, unfortunately, after making sure that Fannie and Freddie came out with the same response, I was not able, because they didn't claim enough income, I was not able to use those distributions towards income. And that put us in a real frustrating position because then they had to go for a non-traditional mortgage. And then suddenly people start with the high interest rate environment that we're in. Well, the rates for those non-traditional mortgages are even higher. So that's where people suddenly start to push back and maybe don't do anything. So what's your interpretation on using distributions?
I don't understand. Well, you know, I don't understand why they wouldn't be considered as income. Distributions are weird, right? A distribution, let's say you had $100,000 in income, revenue in a business, and you had $40,000 in expenses. So you have profit of $60,000. Whether you take that as distributions or not, you're paying taxes on $60,000. If you take it all as distributions, you're paying tax on $60,000. If you take 20 of it as distributions, you're paying tax on $60,000. So I would think if they are taking distributions that they have to be showing profit of some sort down the road, which is what you can take versus looking at the distribution.
That's what my guidelines say. It says the lender, in your case, a borrower has a $40,000 of distributions on a K1, let's say, for example, to use your point, but has zero ordinary income on line 1. The lender cannot use the $40K as income because there's no profit to support it. That's what our guidelines say. It may have come from retained earnings, but not new cash flow.
Right. And so that's a great example of what I could see is, let's say another example is you make $100,000 in profit in year 1, $100,000 in profit in year 2, and you take no distributions. So you now have $200,000 in profit that you've paid taxes on, you've taken no distributions. In year 3, you take all that money out in a distribution and you close the business down and have no income in year 3. That's kind of the example you just gave. It would be, hey, you took a distribution, but you're not showing any profit, but you would have showed profit the prior 2 years. So I guess in your scenario, when you look at a mortgage, you're looking at multiple years and you're thinking, okay, if they're taking these distributions, hopefully there was income in at least the year before or that year that would show that income at least.
Yeah.
But so the question is, and this makes complete sense, but what you're saying also is that even if you can't get a government-backed loan, there's still options out there.
Oh, yes.
It's just a non-traditional option, and it's not going to be as rate-friendly, essentially.
That's accurate, yes. Yeah, there's portfolio loans, there's bank statement, income average loans. There are some other types of loan programs that we will do where we won't even look at income at all. So like the debt service coverage ratio will be one that we should touch on too. And that's also DSCR. We can talk about that one when you're ready.
Let's talk about it. Because another question, and this probably goes along that line, is let's say I am a business owner, had a ton of success, 3, 5, 10 years ago and just sitting on a bunch of cash, and now, or, investments, whatever, and putting that money to work, of course. But now I'm just kind of slowly making money, and we want to buy that $5 million lake house down the road, right? But we're making $100,000 a year. Loan doesn't make any sense on being able to make that work. But I'm sitting on $5 million or $10 million in investments. Can that play into that mortgage? I'm assuming that's kind of the route that we're going down with that other option.
Well, to your point, if you were going to be in a situation where you wanted to derive income, let's say interest and dividend income off of the 5 million, then you would actually need to show as it was reported on your tax return for the last 2 years. And then is that Schedule D, I believe? We would include that income if it was showing on there as a 2-year average. The distinction about the DSCR income, the debt service coverage ratio income, is they're basing that on income only for the subject property. And that means that if it's going to be income from the subject property, that means it must be non-owner occupied. So we are seeing some people who are looking to buy like a group home, or they're trying to buy rentals, and they are using the income solely on the subject property, and we literally do not care anything about what they make.
Got it. Yeah, and that brings up an interesting point too, because and I know that was on one of our talking points, this concept of a rental property and how that works into it, because as another tax play, we often look at rental properties as a potential tax play, whether it's a short-term rental or it's a wealth building strategy and we're doing long-term rentals. And so what you're saying is you can now how do you do that? Let's say you buy a single family home and you say, okay, we're going to turn it into a long-term rental or a short-term rental, whatever. We're turning this into a rental. We're purchasing it. Somebody else was living there. That was their primary residence. So we don't have any history on rental income, but our intention is it's not going to be primary at all. It's 100% rental. Is there a calculation that we take based on the location and area that would kind of touch on that?
Yeah, so what happens is the appraiser does a rents analysis inside the appraisal report, and we are allowed to use the market rents off of the appraisal analysis that shows basically data that's coming either from online sources or the MLS, where we're going to take 75% of gross rents and we're going to offset the mortgage payment from that.
Got it.
That's how we're going to do it.
And is this a government-backed loan, or is this more what you would call the non-traditional route?
Non-traditional. Yeah, if you were going to get a mortgage with Fannie Mae and Freddie Mac, and you were going to use this play where you want to use the rental income from the subject property, like let's say your income allows you to sufficiently support all your obligations that you have right now, but now you want to go buy a single family up north that you're going to just use as a rental, and you're going to go stay there from time to time. Now we get to talk about short-term rentals versus long-term rentals, and we'll do that in just a second. But as it relates to that, the rule says that if you don't have a history of being a landlord, you are allowed to use the rental income for qualifying. You just can't have net positive cash flow above and beyond breaking even. So the fair rental days that are on the Schedule E on the tax return, when it's less than 12 months, we always want to just use the lease agreement, because it's not giving or we would use the rents off the appraisal, because it's not giving the applicant or the person applying for financing a fair shake on what their cash flow should represent. So we just can't have positive cash flow. That's the bottom line. After you have a history of being a landlord, then when you see it on your Schedule E, for example, if you see positive cash flow, that would be the exception to that rule, where you then could positive, let's say you're $500 to the good every month or something like that.
And obviously on the Schedule E, we're still doing the add back of the depreciation, right?
Yes, we add back on the Schedule E. When we're doing those, we're adding back mortgage interest, we're adding back taxes, we're adding back depreciation. Absolutely.
Awesome. And so, I mean, that for all of our real estate investors, that's a really good news, because that's the bulk of your expenses right there, especially if we're, doing a cost seg study, getting a bunch of deductions up front and all those different things. That makes sense. Now, how does this work if you have multiple rental properties? So is it still that debt coverage based on the rents? You have to cover that if you had 10, 20, 30, 40, 50 properties, or at some point do they look at kind of your whole picture, not just your income, but also your whole kind of rental portfolio when doing those types of loans?
If you're in a situation where you were doing DSCR, it's just based on that one specific property. It's not
Okay.
based on anything else that you have going on. But if you were in a situation where you were coming to me and you wanted a traditional 30-year fixed mortgage through Fannie Mae or Freddie Mac, a single family home or a condominium can be acquired with as little as 15% down. If you are going to buy a 2 to 4 unit property, now I'm talking in the space of getting a 30-year fixed conventional loan, you would need 25% down for a 2 to 4 unit. And those cannot be gifted funds. And if the funds are going to come from a business, you would actually need a statement from someone like yourself indicating that the distribution would not affect the safety or the liquidity of the business.
Got it.
And then we're going to use Schedule E, and we're going to do the add backs like we talked about. Or if it's less than 12 months, we're going to go off the lease agreement and we're going to take 75% of gross rents and then offset that against the mortgage payment.
Makes sense. So just, and I'm sure this question is very hard to answer, but if we could try to just simplify it and just kind of do a thumb in the wind guess on it. When you look at a Freddie Mac, if you look at a loan like that and a rate for that versus a non-traditional loan, same individual, what type of rate differences are you looking at? Roughly.
So as far as rate differences, if I was just going to give you a high level ballpark, I would say it's around 1 to 1.5%, depending on credit score and down payment.
Okay. So if the market's at 5% for a government-backed loan, you're looking at 6 to 7% for a non-traditional loan for the same person, same property, same individual.
As of June of 2025, 30-year fixed rate money is sitting around 7% right now, nationally. So if you were in a situation where you were going to buy a rental, that interest rate is going to be somewhere between 7.75% and 8%, depending on down payment and whether or not there's any compensating factors. And then I would add 1 to 1.5% above that if you were going to talk about the DSCR product or something like that. And taking into account too, talking about like the situations where you have some non-QM mortgages. And for those in the audience listening to this podcast, non-QM means qualified mortgage. So what they do is they establish the definition for a QM versus a non-QM mortgage is where you have actually demonstrated an ability to repay the debt. That's the distinction. So we have some community banks, credit unions, hard money lenders, various sources that a lot of these self-employed applicants will seek in order for them to obtain some financing, because maybe they're going to get a screaming deal on the rental property and the cost of funds is a situation they're willing to absorb so that they can get into the building. Or maybe they need to get the building, and maybe by the time they file next year's tax returns, they're going to refinance out of the non-traditional mortgage into something more traditional. Those are all avenues that people like myself are exploring with buyers every day, because we do have a lot of speculative investors out there right now.
Got it. So that is an option, is that if you want to get into a mortgage or you want to find a house, you found the perfect house, but you've been using a lot of tax plays, your income's lower than on paper than you feel like in reality, and but you want to get this house is a house that you want and have to be in. You can go the non-traditional route. Then over the next 2 years, kind of take away some of those tax strategies that you're utilizing, boost up your income from a P&L standpoint, and you could then refinance back into a potentially lower rate down the road.
Yes, that's true. Yes, you can. And what we oftentimes will see is people will, like we said at the beginning of our time together today, start reverse engineering how much income we need to show and then working towards that goal.
Yeah, that was the one thing I was going to ask you too is, is there anything that you kind of recommend to business owners 2 to 3 years out from a mortgage situation where if they, and I laugh at that because there's rarely a business owner that's 2 1 to 2 years out that says, I think I want to buy a home in 2 years. Can you help me plan
Usually
properly for that?
wake up tomorrow morning and decide they want to do it.
Yeah, it's more so Bill's phone's ringing at 6 a.m. and saying, Bill, I need a loan by the end of the week. What can you do for me?
Or at 5 o'clock going into the weekend, and they're going to go see the showing on Saturday morning.
Yes, exactly.
Yeah, so basically, if you've been self-employed for over 5 years, Mike, all I'm really looking for is for you to show me a 12-month average, and Fannie Mae and Freddie Mac are going to accept that 12-month average. So it doesn't have to really be a super long play. That's a uniform guideline nationwide that if you're, we're going to look at your net income on Schedule C, and then we're going to do the add backs. If it's on an 1120S, we're going to take ordinary income, add back your W-2, add back your depreciation. We're going to qualify you based on that 12-month average.
Yeah, that's awesome.
That's the sweet spot.
Yeah, one thing that Bill kind of mentioned is doing that reverse engineering. I think this is important because I talk to business owners all the time and say, well, we're moving soon. There's going to be some mortgage things, and like we don't want to take advantage of tax strategies available to you. And then I oftentimes look at their income and I'm like, well, depending on what they're looking at for a mortgage size, they might only need 10% of their actual income to qualify for the mortgage that they need. So why would they miss out on opportunities that are available to them? Home office is an example, a very easy example that's not an add back. Why would they miss out on taking something that's available to them if just for the fact of potentially disallowing a mortgage down the road, if they didn't even need that much mortgage or didn't even need that much income to show that mortgage anyway? So I love the idea of before you kind of make that decision that I'm not going to tax plan because of a mortgage piece, first check out, see, what are some rough ideas of what your income needs to look at based on the mortgage that you might want, and then say, oh, I do have plenty of room for planning still, and I can still hit that number that lenders would like to see.
50% income to debt ratio is and has been the ceiling for a considerable amount of time on a conventional loan. So basically, if your AGI is, let's say it's, we're just use some simple math. Let's say it's $10,000 a month. Well, now we can take and add up anything that's on the personal credit report, like a car payment, minimum payment on a credit card. Student loans are still a hotly debated topic for a lot of folks. Student loans that are coming out of deferment. There's some specific rules regarding what payments need to be included for student loans that we'll talk about some other time. I don't want to get too far off on a tangent, but we're adding back all those things monthly payment wise. Add in the new projected mortgage payment, and can we stay under 50% of the AGI? That's what we're trying to do.
Awesome. Well, Bill, this has been super helpful, and I think kind of eye-opening, and also just helpful for business owners to kind of think about, what is that world there? Because I think, and this is me sometimes, I'm like, I don't really know, so I just go work with Bill. I send my stuff to him, like, Bill, kind of, you tell me what I can or can't do. But it is good to kind of see, truly what you're doing on the back end, because it helps, from my perspective, understand kind of where there is some planning opportunities and when planning might make sense or not. And, I think the moral of the story, and this goes with everything, is, try to be equipped beforehand. And I say that knowing that, most people, that's not going to be reality. They're going to want to move immediately because something pops up and they love it and they want to go now. And there's no 1-year plan or 2-year plan going into it.
We're dealing with the emotion of it on a constant basis, because usually when a new home purchase comes into play nowadays, because mortgage rates, as we all know, since January of 22 are no longer at historic lows. So people are moving because of things like diamonds, diapers, deaths, divorces, upsizing or downsizing, right? So when someone is going to make a move, it's usually because there's a compelling reason. And sometimes that overshadows like the ability to receive this information from someone like myself and still feel okay with it, because right up until when I told them they couldn't be approved for what they wanted, they felt like they were doing everything the right way.
Mm-hmm. Yeah. Bill the therapist and mortgage lender.
Yeah, there's a suitcase full of hats under the desk for sure.
Well, Bill, thanks for coming on. Where can people find out more about you, kind of what you're up to, what you're doing?
Yeah, so thanks for asking. You can look me up at billthebanker.com. That's where the community bank is that I work for. And if you search for Bill Miller Mortgage Team, and my last name looks like Moeller, Bill Miller Mortgage Team, I'm all over the web. lot of Google reviews, and I definitely keep a pretty strong play on social out there too. So I appreciate you asking.
Awesome. Well, that's a wrap. Huge thanks to Bill for sharing some real insider insights here. We covered a lot, from qualifying for a mortgage while using tax strategies to preparing for rental property investments to start the smart way. Remember, tax planning and mortgage readiness don't have to necessarily be at odds. With the right planning, you can have both. And if today's episode helped clear up any confusion or spark some new ideas, don't forget to share it with a fellow business owner. And as always, subscribe so you never miss another strategy session. Thanks for coming, and I'll see you on the next one.